Cash management. If you operated your business in a utopia, your cash flow would be very simple. Cash or sales would come in right when cash outflows or bills were due. Unfortunately, this is rarely the case. The concept of cash flow, therefore, is about timing. While most of us are familiar with the concept of profit, few of us are well versed in the concept of cash flow. Profit is the difference between income and expenses. It is a snapshot of a business at a given time that represents what comes in and goes out, including depreciation of assets, accounts receivable, and other non-cash items. Cash flow is a dynamic picture of the flow of cash through a business with the larger concept of timing throughout. Remember the golden rule. The golden rule of business is never run out of cash. Cash flow management will help you keep this golden rule afloat. To analyze cash flow, we use several terms. Accounts receivables are sales that have not been collected on. Credit terms represents the time limits you have set for your clients to pay on their sale. Credit policy is the blueprint your company uses to extend credit to customers. Be sure that yours isn't too strict or too generous. Inventory is extra merchandise or supplies needed on hand to meet customer demand. Too much inventory ties up too much cash that could be used elsewhere. Accounts payable, this is terms that you have with your suppliers. The longer you have to pay these bills, the more optimized your cash flow is. Determining the right amount of cash needed to operate your business. One common formula is earnings before interest and taxes plus depreciation and minus taxes. This formula represents the main differences between the income statement and the sources and uses of cash statement, although some argue that this approach is oversimplified. Another way to determine the right amount of cash for your business is budget forecasting. Working budgets can help you to visualize the inflow and outflow of cash with special attention to heavier flows during different times. This ensures that you may be prepared both for the rise in cost on months your expenses are higher and also have the ability and flexibility to capitalize on opportunities when they arise. How is cash used in a business? The sources and uses of cash sheet can help you to further define the uses of cash in your business. Examples include payroll, inventory, materials, labor, marketing, taxes, leasehold improvements, equipment, rent, and utilities. But how much is too much? Having too much excess cash means having more cash on hand than what is needed to operate the business. Some accountants use a general rule to not keep more than 20% of your revenue on hand. Excess cash can cause owners and managers to make value dilutive investments such as unprofitable business ventures like new product lines. Make your excess cash work for you. Excess cash can be used in the following recommended ways. Give yourself a bonus, although be aware of tax implications. Buy back stock. Reinvest in new equipment, expansion, or training. Pay down debt, term investments. Take advantage of prompt pay discounts from vendors. Having excess cash can also avoid the need to acquire future financing. Running out of cash, on the other hand, can mean certain death for many businesses. Even profitable companies can run out of cash and go under.